What's going on, guys? Welcome back to the channel. In today's video, I have the usual DB, but I have another special guest with me, Nodi. He's going to be hopping on today to give his perspective, his macro analysis, all that good stuff. Let's jump into the charts. So the first chart that I have here today is going to be BTC as usual. I have a few charts to show you guys since the last time. It's been a little bit since we've dropped a video on some analysis, but that's the nature of the market we're in. We're in a range till proven otherwise. And this very move that's happened today shows you exactly that. We had weekend chop around the mid end of this range, and I'm going to consider the mid end of this range as a range on its own. Anywhere from that mid to low 67 range right down to that mid 66-ish range is going to be a mid range for me within this higher time frame of consolidation that we're currently chopping around before the next move actually happens. So again, we chopped around the low end of the mid end of this range. We popped up above it once, rejected at that 69K pivot that I've been talking about for weeks now, and printed a higher low, very cheeky one over the weekend, before continuing up and taking out those highs that I just circled out to the left. And we're trading below that 69K pivot that I just brought up right now. Eventually, a move is going to happen from that 69K region. And in hindsight, we're going to be saying, of course it did, whether it be to the upside or to the downside. Eventually, a move is going to happen, and you have to play the market as such. You cannot chop yourself in between. And if you are playing in between, you have to respect these position size according to what the market is offering and to what it's giving you. Now, most recently, what I liked as far as an entry trigger in the last 24 hours or so is more or less this sweep of liquidity to the upside here, where we took this flat candle sort of high and swept it at around that 70K psychological level of resistance. So yeah, 69K is a level of support resistance, whether we're trading below or above it. We also have that 66K level, 67K level. These are all psychological levels. As we do trade more around them, there's more price action that is going to be distinguished around these levels. We had a sweep, a close below, and then a push and another sweep of that initial high and a close below that. That's an SFP. Trigger for a short entry. And we're seeing a rejection come from that to start the week off right now. What I would do initially to start off this week is seeing what the Monday range is giving us. It's Tuesday, so naturally speaking, people are going to want to play these Monday sweep sort of entries. And I think that's not a bad way to look at the market. I do see a sort of lower time frame, higher low potential with this trend here as a trade setup being formed. I did enter slight longs here at 66.7, and I'm looking to scale bids down to 67.3. I did move my stops up for the top end bids, and I'm willing to look to see for a reaction if we do sort of look to sweep these lows for possible either continuation to take these highs or for a potential lower high above that 69K pivot again. I don't think that we're going to full on reject straight from here, giving short entries a very tight invalidation. And I'm not also looking for a full on engulfing of the highs just yet either. I think that anybody trading this range, anticipating a move towards the highs significantly or towards the low significantly, you're going to end up round tripping a lot of profit. You're going to end up chopping yourself up to bits. And I think that just scalping until proven otherwise or executing supremely at extremes makes the most sense here for me. So that's more or less what I'm looking for in an intraday perspective. From a higher time frame perspective, I'm looking for, and I guess I don't really want to say this as a higher time frame perspective. This could happen tomorrow for all we know. Is I'll be looking for just a retest and a sweep of these wicks. This is what I wanted before we had our most recent pop. Even though I was long from 65.8, I got taken out break even just before this move actually happened. So I was able to take profit on this initial move. I took half and then I moved my stops up. So I got taken out here before this actual move happened. I was looking for a sweep to add. And I'm still interested in doing so if that comes, which is why I was a little cautious in moving my intraday limit up break even right now that I did snipe it around 67.7. That entry is risk-free, and now I'm just kind of waiting to see what the market wants to give. If we start to accept above the Monday low, I'll act accordingly. If we move down lower and we give lower time frame means for me to enter, I'll do so accordingly. For ETH, I have similar perspective to BTC, except it's a lot more, I'd say a lot more tight and compressed for ETH. We're still in a range for it, as we see here. And I draw this range here in its own area for a given reason. We had this drop and support sort of hold before we eventually broke that structure and rejected that top end block to the most recent low that we have right now on ETH. And we respected this area as a range this whole time that we've been trading around it. And for me, it's important to keep treating it as such until proven otherwise. We saw a nice move to the upside before blatantly accepting right back below it into a steep higher low climb here. Again, top end of resistance, top end of the block. This can easily reject, so you do want to be cautious, but to coincide with BTC, this can for sure hold and push the highs to the upside, assuming that shorts are piling in with their stops above the highs. That's a natural place to put your stop above current liquidity. And we do have tight liquidity that was saved on these last moves up. So I'm also monitoring that as a potential situation. On a more higher time frame aspect, I'll look towards the lower end 1800 level to get tested. That would be a natural level for me to go extreme long on. That's the extreme end of the range. That's the extremes that I was speaking about. As far as outliers in the market right now, we see Zcash broke out of a trend pretty strong. Not going to clarify too much on what's happening there. I was pointing out this trend break yesterday as a potential, anticipating that. I did enter a spot long on BCH. I see this as a potential as well because I had a perception of us moving into that 380 region, which would be a good weekly level of demand here. For me, I think that the extremes are already being tested on this pairing, and I'm seeing strength start to come in on this pairing. So for me, taking a spot entry with my invalidation at where I would enter, assuming that it won't hit and leave me behind, is not a bad move to take. On leverage, being a little bit cautious. On spot, I'm willing to take that. That's about it for me today, guys. I'm interested to hear what Nodi and DB have to say about the situation, and of course, to look at their analysis as well.
Beautiful analysis, Woods. So let me get into my charts. Before I get started, I just want to say that it is important to also check the last video we recorded with Woods, because we did cover a lot of indexes and charts on more higher time frames, and not much has changed since we recorded and published that video. So I won't be covering all the indexes for now. I'll just be covering BTC on the daily and the 3-day. For BTC, what we covered last time, we said that it is trading in what I consider a bear flag or a diagonal resistance that is still being respected. Within that higher time frame bear flag, we now also have a more lower time frame bear flag, so a baby bear flag, if you want to call it that way. Usually that's not a very positive pattern. And as long as this is not invalidated, and as I said in the last video, we don't see a move back into this more higher time frame bear flag, then I'm always speculating on lower levels, so always a bit risky to be positioned to swing long. I'm not talking about lower time frame scalps. Of course, BTC, especially when it is ranging, it is great for trading it both up and down, but on more higher time frames, we need this area to be recovered to minimize the chances of a short-term breakdown, which to me remains the more likely scenario. Even on higher time frames, the macro structure, I've covered it several times, still relatively negative. We did have a bearish retest here. We are still in a macro downtrend. Ultimately, that is going to be broken. As of now, I don't yet have long-term buy signals that have flashed, so I think a little bit more pain in the next few weeks and months before we get to buy and then ride everything higher in the next few months and years. Everything we're seeing right now, the weakness in stock markets and crypto, it's very normal. It's what has happened in previous midterm election years as well, where we have seen weakness. The average drop of the S&P 500 in midterm election years, so in 2022, for example, or 2018, has been 15%. And then what has followed was usually a very, very bullish year after that. So for now, we have dropped about 10% for the S&P 500. Certainly, this midterm election year is a bit different considering oil prices, and I'll get to that in a second. But for the S&P 500, from a technical perspective, we are seeing another bearish retest here, the weekly 21 EMA and the weekly 50 SMA, very, very big levels that have been lost. We did bearish retest them before. So overall, this area between 6,500, I would say, to 6,700, 6,750 is an area that needs to be recovered to turn short-term positive on the S&P 500. And if we fail to recover this level here, I will be looking for the previous all-time high, and then there are a few other areas of interest like this 5,750 area, the CME gap. Then we have fib levels as well. Then if we want to drag some diagonal trend lines, we can certainly do that as well. So a few areas of interest where I would be buying if we get the opportunity to be buying this year will be highly dependent, in my view, on the situation in the Middle East. I'll cover that in a bit. For more precise indexes and more precise positioning into stock markets, you can always follow the Bloomberg indexes, like the Bloomberg Artificial Intelligence Index, which has been suffering a bit lately. Also very, very normal because AI stocks have been very strong last year. So it's always normal to see this decline. I would be really interested if at some point we would go to this 9,500 area. We will see if these fib levels will become relevant or not. Again, it's a bit too early to make such predictions because it will depend a lot on the current oil situation. Another index is the Bloomberg Magnificent 7 index, also been dropping now at the support area, previous all-time high. So it's not an area where I would be overly bearish on stocks, not an area where I would be looking to short stocks, especially not within the Magnificent 7. If we fail to reclaim this EMA and SMA here, again, there are a few zones of interest. Obviously, this diagonal trend line on the daily, which is interesting. And then lower than that, we do have some CME gaps and fib levels, but we will be navigating the market from level to level. So this is it in terms of stock markets, the S&P 500, a few indexes that I'm following. What is very important is the situation with oil, right? It's not to be underestimated. In my view, people do put a little bit too much emphasis on daily headlines, right? Which makes them flip-flop between being long and being short. On the greater scheme of things, I don't think these headlines matter too much. And oil markets are telling you that they don't matter, right? What really matters is that the Strait of Hormuz is partially, if not fully, closed, especially for Western ships, and the infrastructure damage that has been done in the Middle East when it comes to energy plants, for example, right? So, despite headlines about ceasefires, about a peace agreement, oil prices remain high, right? They're not fluctuating as much as crypto is between headline to headline. And I think this is not to be underestimated because the mid to long term implications of higher oil prices can be very, very severe on economies, on markets. You're probably already feeling that when you go to fuel your car. The diesel prices are already very high, right? And I think the spillover effect on other industries will take a bit more time to hit, of course. The lagging effect is there. But if these oil prices sustain, I think it's something to worry about in terms of mid to long term perspective. Ultimately, I do think that these oil prices will lead to great, great buying opportunities. So I'm not a doomsday caller per se. I'm really excited from an investor's perspective about the things that we are seeing because these things can put pressure on risk assets because if oil prices remain high, it means that inflation will remain high. And it also means that global central banks and the Federal Reserve in the United States will be forced to combat inflation that is a result of rising oil prices, right? So that would be a more hawkish approach to markets, taking liquidity a bit away, maybe not too much because economic growth is also at risk to a certain extent. If you look at the labor market in the United States, right, the Federal Reserve is a bit in a tricky position between navigating between increasing inflation and weakening labor market. But on the greater scheme of things, I think that if inflation and inflation targets deviate significantly from the Fed's 2% target, they will have to deal with inflation, which I think will also have major implications on DXY. So this remains a very, very important index to follow, still struggling to reclaim the 100, area. I think there's one reason apart from it being a logical resistance zone to why we haven't recovered this area yet, and that is that markets do not necessarily expect more rate cuts, at least until the end of next year, but they're currently also not expecting rate hikes because of the weakness in the labor market. I think if inflation data keeps on increasing or suggesting that inflation will increase, and the market starts speculating on rate hikes to happen this year, we could have the catalyst for the dollar to recover this area and potentially move all the way to 105, 107. I think that would keep pressure on risk assets higher. On the other hand, if there's no speculation on rate hikes coming and DXY remains below this zone, I think it's only locally strong and there will be less pressure on risk assets. So overall, I do think oil prices are not something to be underestimated. Keep an eye on them. If you're bullish on the markets, you want to see them sustainably come down. I'm not talking about the 30-minute chart and a little drop on oil price. I'm talking about a sustainable and strong trend down. If you're bearish on risk assets, if you want cheaper prices, you want these oil prices to remain high from an investor's perspective. So this is all I have about BTC, about DXY, current macro developments, and stock markets.
Hey guys, I hope you're doing well. I'm Nodi from Wealth Group. I'm macro analyst and I am happy to be here to share some macro insights with you. Okay guys, so for me the most important thing is that people understand what's driving the markets behind the scenes. Okay, because everyone sees red candles in the charts, everyone is surprised, but you need to understand these macro mechanics. This is a picture that I shared in my corner early last year. And this was the reason why I went heavy into the asset markets, because oil was falling, the dollar was falling. And when two of these three are falling, usually asset markets become a big tailwind and they do usually well. So, and now we have oil rising, we have the dollar rising or bottoming. So it's the opposite situation. It's rather risk off instead of risk on. And why is that important? Because when the dollar rises, most big countries have their debt in dollar. And when the dollar rises, their debt burden gets bigger and they can't stimulate their economies as easily as when the dollar is low. And oil is needed in everything, okay? And when oil prices rise, production costs rises also. So the big companies will have less profit because they have to spend more money on production costs and so on. So companies can buy less stocks, can rise wages not so much. And yeah, this impacts economies and asset markets. If you look here at the dollar, it's rejecting at this level, as DB said, but I think it's just a matter of time till we break through this level. And then we could see another leg lower in asset markets, because usually the dollar is inverse correlated with asset markets with a delay. That means if we break out here, we could see an push lower a few weeks later in asset markets. And if you check the oil chart, we made some bull posts about oil back here. We bought some Chevron, which is a big oil company, as we expected oil to bottom here. Of course, I don't expect that such a big candle and all the noise with the war, but the base case was that oil is bottoming. And it's pretty wild because Bitcoin topped here and the stock market topped here. And oil is a pretty important chart to watch. Now is not the time to try to catch this candle. This train has left the station, in my opinion. When it comes to Bitcoin, people are always surprised. Why are we going down? Why are prices not going up? And so on. But at the end, if you understand asset markets, if you zoom out, we are just repeating what we do every 4 years in every midterm year, because we always have 3 years up and 1 year down, 3 years up, 1 year down. That's the nature of asset markets. For the stock market, it's similar. It's more like 3 to 5 years, but also midterm years are usually weak. And for Bitcoin, we see it even more extreme. If you zoom in a bit, then we get this pattern. Bitcoin bottoms always around 12 months after the top. This would bring us to a bottom between August and November 2026. Then, of course, we have the halving again. This could bring us to a cycle top around August and November 29 if history repeats. Of course, at some point this will break, but till it doesn't break, till it repeats, we need to respect it. It's very risky to bet against the history. And another cool metric that I want to show you is the BTC realized price band. This black line is basically the average price every Bitcoin holder has paid. So this tells you if you are far away from the black line, let's say in the orange area or even in the red area, you are way above the average price of all Bitcoin holders. This means many people are in big profits. They are sitting in profits that they can dump on you. So the risk reward gets worse if you are in these areas, and it doesn't make sense to accumulate Bitcoin in these phases. You want to accumulate Bitcoin when we enter the blue phase below the black line, because this means most people are in losses or are selling in losses. And if not many people are left to dump on you, that means the downside is limited. So this is the phase to be aggressive, and we reach this phase every 4 years. And I think this year won't be different. Nah, this would bring us to prices between 50 and 40K. And overall, I don't trade much, as I'm a macro guy, but what I want to show you is this line. This EMA is the 50-week EMA. That's the golden line. I think that's the most important line because it got respected the whole bull run, as you see here. And since we lost it, it was pretty clear for me that we entered a bear market. And then we got this nice retest where I shared a short for the group, and we catched, I think, almost 40% short on it. And yeah, then we TP'd here, bought some Bitcoin, and now we are just doing nothing. For me, that's a TP zone. For me, that's a drink T zone because the risk reward isn't good to buy or to short or anything at the moment. So I will just let this go sideways and wait for my green zone, hopefully in the second half of the year. But I think we could get soon another short opportunity in this red zone when the golden line comes even lower into this zone, and then we get a nice setup for another swing short, potentially between 79 to 82K. Okay, and just to go quickly over the stock market, in this area here we shared a warning signal for the stock market because the S&P 500 was exhausting. That's a pretty important Fibonacci level here. Since then, we are going pretty much down only. Now a bit there of a relief phase, but I think one of these scenarios is the base case for now. Either we get the bearish retest into this all-time high, and then we build some momentum into new highs again, or we go even lower to fill this gap here. Okay, you need to keep it simple. What's the biggest support? Where's the biggest gap? And these are the areas you should need to watch and ignore all the headlines and keep it as simple as possible. And yeah, overall, I think the environment is very noisy with many headlines. So it's really helpful to be in a good community to learn from each other because markets can be stressful, especially if you're alone in the market. That's all I have for today. Thanks for having me, guys, and have a wonderful day. Bye-bye.
I love your perspective. I love your outlook on things. Even you guys bringing up certain things that I don't look at every day because I do look to, I mean, intraday trade the market a lot. But as of lately, I've been very selective with the coins I trade and the actual price action I'm even trading around. So I do love the more macro analysis. I think that really counteracts well. And to your point, yeah, having a community is a giant thing, especially in these slow grinding, quiet markets, because at the end of the day, there's always something to be done. Even if you're not taking a trade every day, there's something to do. You could analyze, mark your levels, curate a good watch list, formulate where your areas are to sell or buy, and so on and so forth. So set yourself up for success, and that doesn't come with instant gratification. That's kind of how I look at the market right now, like you're not going to get instant gratification right now. And I think a lot of people that lost or are continually losing in this market are looking for just that. And the liquidity is so tight and thin.
Yeah, well said. And I mean, one thing that I just have to re-emphasize over and over again is that market might appear difficult for many people, right? But I think ultimately, and I really mean this, is that from an investor's perspective, wealth is created in bear markets, not in bull markets, right? It's when nobody's around, when people are not interested in asset markets, where everything is undervalued, cheap, that's where you want to be interested. So Nodi and I, we might be bearish for a little longer, but we won't be forever, because we understand that how macro cycles move, and that, you know, for every bearish market there's an even stronger bullish market. We're gonna be here. We're gonna try to help everybody navigate these markets, these what might seem as difficult conditions because of different headlines and news emerging left and right. But ultimately, as we said, we're just seeing things that we have seen in previous midterm election years. So it's nothing extraordinary, right? So some might see it as difficult environment or bad prices. We see it as big opportunities coming up. And I think it's a very important difference in how you approach this market mentally, right? Between taking it with cope and frustration, or just seeing it as a big opportunity. And I think the latter should be the case.
Thank you guys for giving your analysis. Always a good outlook and a good way to begin the week, really, with you guys. So look forward to posting this up. I look forward to hearing your guys' feedback on the video. Let me know how you guys like this analysis, and we'll see you guys in the next.